Hi friends, welcome to RecTV Education. Today we are going to discuss about salaries. This is one of the topic of direct tax. Till now we have seen about income from other source, income exempt from tax, such topics. And today we are going to salaries. Let us see what is the general rule. General rule is that salary will be deemed to accrue or arise at a place where the services is rendered. So friends, when we provide services to such companies or partnership firms or anything, we will get a salaries. This is the topic we are going to learn about salaries and how the tax will be impact in the salaries. Let us see in brief. If salary income for services rendered in India is deemed to accrue or arise in India. So friends, when we provide services in India, so it is treated as the income is deemed to accrue or arise in India, means it is arising in India even though it is paid outside India also. So friends, if you provide services in India and you are taking salary from another country also, it is deemed to accrue or arise in India only. So tax will be deducted in India only. Now, salary payable for rest periods or leave periods which is preceded or succeeded by services rendered in India shall be regarded as income earned in India. So when you provide services to a companies or any firms such as establishments, you will get an income, that is we call as salaries. It is preceded or succeeded by services rendered in India shall be regarded as income earned in India. Let us understand the meaning of the term salary. Section 17 subsection 1, it includes number 1 basic salary. It includes basic salary, bonus again divided into two parts, that is statutory bonus or non-statutory bonus. Commission it is whether it may be variable or it may be fixed. Next, the dearness allowance is there is two types. What is DA so provided and DA not so provided, and another is other allowances. We can see these other allowances in further, and also perquisites means giving benefit to the employees. It is called as a perquisite, and further we can see it clearly. And leave salary, the salary also includes leave salary. And next is contribution to retirement benefits, and the last is profits in lieu of salary. These are the items that are included in the salaries. So in salary definition, it includes dearness allowance. Then what it is, let us see. Understanding the meaning of the term dearness allowance, that is DA provided or DA not so provided. If DA provided, the portion of DA which is considered while contribution to the retirement benefits, and the DA not allowed, the balance portion of DA, it is not included for the retirement benefits. Now we are going to look at tax treatment of leave salary. What is leave salary? What is the meaning of leave salary? Leave salary doesn't mean salary paid during the leaves. It is the not meaning for leave salary. It refers to the salary paid for not taking the entitled leaves. So the company entitled some leaves to employees. If those employees who does not entitle those leaves, will get a leave salary. Now let us see the tax treatment of leave salary. If the leave salary is received during the services, it is fully taxable. And when we come to the another part, that is leave salary received during the retirement or recognition or superannuation, it is again divided into two parts. That is, one is GOUT employees. Let us look at the GOUT employees portion, that is GOUT employees. If the leave salary received during the retirement or recognition or superannuation by the GOUT employees, it is fully exempt. Here the GOUT employees include central government employees or state government employees. And the another one is non-GOUT employees. There is a separate tax treatment for this. Let us see. That is 1A, that is cash equivalent of leaves standing to one's credit. That is leaves entitled should not exceed 30 days. You will arrive one amount. So I took an example of XXX, and the B, last run 10 months average salary. Here salary includes basic plus DSO provided and commission, and the actual salary received, and the how much the actual leave salary the employee received. And the D, maximum exemption is 3 lakhs. So from A or B or C or D, whichever is low, it is exempt from tax, and the remaining amount is taxable. So friends, once you look at the total chart, tax treatment of retrenchment of compensation. Retrenchment compensation refers to compensation received for loss of employment. It is mostly found in like software fields. Under the Income Tax Act, retrenchment compensation is exempt, being the least of the following. That is, A, 15/26. That in a month, 26 days has been taken, and in that 15 days, that is 15 divided by 26 into 3 months average salary. That is, you should do last one of 3 months average salary into completed year of services and the part of excess of 6 months, that is greater than 6 months. That means if you worked for 7 months, that year also should be included as a year. And B, actual retrenchment capital received. And the C, maximum 5 lakhs, whichever is low is exempt. That is, A or B or C, whichever is low is exempt. After we arrive the exemption amount, the taxable retrenchment compensation would be actual amount received minus exempt. The remaining amount is taxable. Tax treatment of pension. Here, pension refers to amount received post-retirement with the name called pension. Pension can be commuted pension and uncommuted pension. If pension received in lump sum, it is called as a commuted pension. And uncommuted pension means it is received in installments, that is monthly, quarterly, half-yearly or annually. Such type of pension is known as uncommuted pension. Now, full pension means had assessee withdrawn 100%, what amount we should have received, it is called as full pension. Example, Mr. X draws 70% of pension balance and receives 7 lakhs. Then the full pension would be 10 lakhs. Now let us understand the chart. That is, here pension is divided into two, that is uncommuted pension and commuted pension. Uncommuted pension is always taxable. And when it comes to the commuted pension, here it is again divided into two, that is government employees, that is government employees. Here in the government employees includes central government, state government, local authority, statutory corporations. And when we comes to non-government employees, it is again divided into if gratuity exemption is availed, if gratuity exemption is not allowed. So for the government employees, that is central government, state government, local authority and statutory corporations, these all the employees, for the pension it is fully exempt. When we come to the non-government employees, already we have said that if gratuity exemption is availed. So if non-government employees, if they availed gratuity exemption, then the exempted pension will be 1/3 of full pension is exempt. Note, that is taxable commuted pension is equal to amount received minus 1/3 of full pension. And when we go to second part, that is if gratuity exemption is not availed, that means non-government employees does not avail gratuity exemption. Here the exemption pension is half of the full pension. So what is the taxable commuted pension? Here it is amount received as a pension minus half of the full pension. The remaining balance is taxable commuted pension. Now we have taken one example for tax treatment of pension. That is, Mr. X is a retired employee. He has received pension from the beginning of the previous year, that is with effect from 1st April 2014. The per month pension is 5,000. On 1st January 2015, he has committed 70% of his pension balance and received 7 lakhs. You have to require to determine the total taxable pension for the previous year 14-15. So when we coming to the solution, there is 1415 and up to 1st January 2015 the 9 months per month pension is 5000. After that, on 1st January 2015 he has received commuted pension, that is 7 lakhs. So total pension would be 10 lakhs. Now balance 3 months he has received per month pension is 5000 into 30%, that is 1500, because previously he took 100%. Now he has to be taken only 30% because he has already received commuted pension 70%. Therefore 5000 into 30% is equal to 1500 per month. Now the uncomputed pension is equal to total pension for 9 months is equal to 9 into 5000, that is 45000. After that, after he receiving commuted pension 7 lakhs, his pension has become 1500. The balance period is 3 months. Therefore 3 months into 1500 is equal to 4500. And the commuted pension, that is he has received 7 lakhs. For that there is a exemption according to our treatment, that is tax treatment of pension. It has exempt portion is 3,66,667. So the balance portion is taxable, that is 4,16,667. Tax treatment of allowance. This is divided into 3 types, that is type 1, type 2, type 3. Before going to learn this, first, what is allowance? Allowance refers to the money received with a purpose of attachment. The allowance may be given to official duties or personal purpose. Few of the examples of allowances are travel allowance, transport allowance, research allowance, etc. Now let us see the tax treatment of allowance. This we can be learned in 3 types, that is type 1, type 2 and type 3. Now type 1 deals with taxable allowance is equal to amount received minus amount spent. Under type 1, following allowances can be learned, that is travel allowance, transfer allowance, conveyance allowance, daily allowance, uniform allowance, research allowance and helper allowance. Now when we goes to type 2, that is taxable allowance is equal to amount received minus amount, that is fixed exemption. Under these the following allowances are transport allowance, that is 800 per month, it is fixed exemption, and the person who are disabled there is a exemption, that is double 1600 per month. Now child education allowance. For child education allowance 100 per month, it is fixed per one child. This allowance is allowed maximum to 2 children. And when we goes to hostel allowance, this amount is 300 per month per child, it is fixed and the maximum is 2 children. And allowance received by transport employees, that is the exemption part is 70% of such allowance or 10,000 per month, whichever is low, that is exempt. And when we go to type 3, other dealt with other allowance, that is dealt separately. So friends, this is the allowance topic, and let us see the difference between travel allowance and transfer allowance. The travel allowance means if you are working in a company, the employer, that is company, provides traveling allowance, that is buses or car or pass. These are the travel allowance. And when we comes to transfer allowance, when you are working in a company, there is a transfers. So if you are working in Hyderabad and you are transferred to Bangalore, this is the company provides amount, that is transfer allowance. Convenience allowance is also transport allowance, like daily charges, that is from office to your home and home to office. This is the convenience allowance. So these are the allowance, friends. Tax treatment of HRA under section 10 subsection 13 clause A. HRA refers to house rent allowance, that is amount received by the employee from the employer for paying domestic rent, that is house rent. It's a matter of common sense that exemption would be given only if amount is spent as rentals. Now HRA exemption is given under section 10 subsection 13 clause A, which is as follows: that if rent is paid for building in cities like Mumbai, Delhi, Kolkata, and the list of the following is exempt. That is A, 50% of salary. Salary here includes basic salary, DSO provided and commission, and actual rent HRA received. And rent minus 10% of salary, whichever is low is exempt, and the remaining balance is taxable. Let us see once again. A, 50% of salary. Here salary includes basic plus DSO provided plus commission. Or B, actual HRA received. And C, rent minus 10% of salary, whichever is less, is exempt from tax. And in case of other cities and areas, list of the following is exempt. That is 40% of salary. Here salary includes same as before, that is basic salary plus DSO provided plus commission. And actual HRA received. And C, rent minus 10% of salary, whichever is low. Let us write some notes. That is, the HRA exemption depends on the following factors: the place of posting, and B, the salary amount per month, and C, HRA amount, D, the rent per month. If the assessee does not incur any rental expenditure, then the HRA exemption would be nil, and the entire HRA would become taxable in case of self-occupied house, that is residential. If rent minus 10% of salary is negative, then HRA exemption would be nil, and there will be entire HRA would become taxable. And we know salary for HRA means basic salary plus DSO provided plus commission on turnover. However, any areas of salary or advance salary should be ignored. If HRA is received only part of a year, then the rental expenditure should be considered only that part. Example, HRA received for 9 months from July to March, then the rental from July to March should only be considered. In allowance, there is a last topic, that is other allowance. That these are type 3 allowance. These are the allowance which are fully taxable. Those are lunch allowance, tiffin allowance, entertainment allowance, telephone allowance, medical allowance, non-practicing allowance, and servant allowance. So these are the allowance which are fully taxable. Beside of the board we have written there, beside all allowance there is no exemption. So these are fully taxable. Now we are going to the topic of perquisites. What is perquisite? The term perquisite is defined in the section 17 clause 2 of Income Tax Act. In layman's version, perquisite refers to it is a benefit or facility or amenity. It is also a type of facility provided by the employer to employee. Then what becomes important to determine the value of taxable perquisite? Here the question arises. For this, Rule 3 of Income Tax Rules 1962 provides the valuation of perquisites. Let us see few examples of perquisites. What are those? That is RFA. It means rent-free accommodation. And second one is concessional loans. And third one is use of movable assets of employers. That means the employees' movable assets are used by employee. And the electricity, water, gas facility provided by the employer to employee. All these are benefits to the employee. So we call it as a perquisite. The very purpose of determining the value of benefit that provided as a perquisite is to make it taxable in the hands of employee. That's why we value the perquisite values. Now we goes to the next topic, that is use of employer's assets. Now we are going to learn one of the perquisite, that is use of employer's assets, that is other than cars. If the assets are used for official purpose, that is office purpose, there is no perquisite because they are given primarily for official purpose. Example, use of laptops and mobiles, etc. These are the some of the perquisite which is not taxable because it is given primarily for official use. Now, if the assets is given for personal purpose, example fridge, TV, etc., then the taxable value of perquisite is, if the asset is owned by the employer, then 10% per annum of original cost of asset minus recovery from the employee. The balance amount is taxable. If the asset is leased by the employer, then the taxable perquisite is lease rental per annum minus recovery from the employee. The balance amount is taxable. Now let us take notes on use of employer's asset other than car. This note is for if the asset is used for personal purpose, that is 10% per annum should apply on original cost and not on written down value. And second thing is, if the asset is given only a part of a year, then the perquisite would be taxable only that period. For example, if Mr. X an employee has been given a fridge of rupees 40,000 for personal purpose, but the facility is given from July 1st, and there is a recovery of 200 per month from employee. You are required to determine the taxable perquisite, that is 40,000 into 10 percentage. 40,000 into 10 percentage, because it is used for 9 months, so we are taking only the period of 9 months, that is 40,000 into 10 percentage into 9 divided by 12 minus, we should deduct recovery amount, that is 200 per month. It has recovered for a period of 9 months, so 200 into 9 months, and the taxable perquisite is 1200. If the accommodation is provided in a hotel, if accommodation is given for official purpose, that is not taxable. Otherwise, if accommodation are given less than or equal to 15 days, not taxable. If the accommodation are given more than 15 days, 24% of salary or rent of hotel minus recovery, the balance amount is taxable. Let us see once again. If the employer provides accommodation in a hotel, that is other than rent-free accommodation, if the accommodation is provided in a hotel, there is two situations. If the accommodation is given for an official duty, that is official purpose, then nothing is taxable. Otherwise, there is a two situation. If the accommodation are given less than or equal to 15 days, nothing is taxable, and if the accommodation is given for more than 15 days, then 24% of salary or rent of hotel and minus recovery, that is recovery from an employee, the balance amount is taxable. Perquisite in respect of interest-free loans or concessional rate of interest. If an employee takes loans from his employer, then there would be a taxable perquisite. For computing taxable perquisite per annum, we should compare SBI lending rate with employer lending rate. That means if you take a loan from your employer, then you should compare the interest rate with SBI lending rate. If SBI lending rate is 12% and the employer lending rate is 10%, the balance portion, that is 2%, is a perquisite in the hands of employee, so it is called as a perquisite in respect of interest-free loans. Now, SBI lending rate should be taken for the relevant purpose, and that to the rate as on 1st April in the previous year, that is in which year you are taking the loan from your employer. Now, perquisite should be computed only an outstanding amount. So, if you are paying your loan amount installmentally, so you should calculate the interest rate on the that is on the balance outstanding amount. So it is the balance outstanding amount, on that the perquisite should be calculated. If the amount is repaid in part during the month, then we should apply the logic of maximum outstanding monthly balance. So in the following two cases, we should not compute any perquisite. That is, if you are taking loan from your employer for all that, so you are taking loan in a lump sum, so all that put together, if it is does not exceed 20,000, so you should not calculate perquisite in respect of interest-free loans. And another case is, if the loan is taken from your employer for medical purpose also, you should not calculate the perquisite value. Perquisite by way of providing servant facility. If employer provides servant facility to employee, the taxable perquisite would be expenditure incurred by employer to provide servant facility, and you should deduct recovery from the employee. So the derived amount is taxable perquisite. Now, facility by way of supply of gas, electricity or water. So there will be a taxable perquisite is cost incurred by the employer minus recovery from employee. The derived amount is a taxable perquisite of gas, electricity or water. And the last, perquisite in case of life insurance policy. If an employer pays insurance policy amount to protect employee, then there would be a perquisite. If the employer pays such premium for employee, repeat, perquisite in case of life insurance policy. If the life insurance policy premium is paid by the employer to protect employee, there would be a taxable perquisite. However, in a case if the employer pays policy premium to protect employee under labor law, there would be no perquisite. So there is no taxable perquisite. And if the employee pays life insurance premium to protect employee for the dishonest of employee, then there would be a no perquisite in the hands of employee. Now about gift. If gift allowance, that is gift in money terms, it is taxable, while gift in kind, then if aggregate value of all the gifts does not exceed 5,000 per annum, it is not taxable. Else if the gift exceed 5,000 per annum become taxable. Note, as per the provision of the Act, once the value of total gift exceed 5,000, entire portion become taxable. And one more note, if in exam gift is tested, we should write the provision of the Act first and express alternative view as given in CBDT Circular 15/2001. In a case, if there is a transfer of second-hand asset at nil consideration to employee, then the perquisite should be computed by applying the logic of purchase of second-hand asset, but it should not be treated as a gift. This is all about the gift provision. Now we are going through another perquisite, that is rent-free accommodation. In rent-free accommodation, there is two situations, that is government employees. The taxable perquisite will be license fee as determined by the central government. And when we comes to the non-government employees, there is again two situations. One is if the accommodation is furnished and unfurnished. And in furnished, again the situation is divided into two types, that is if it is owned by the employer. In this, if the population is greater than 25 lakhs, then the 15% of salary is taxable perquisite. If the population is greater than 10 lakhs and less than or equal to 25 lakhs, then the taxable perquisite is 10% of salary. And if the population is less than or equal to 10 lakhs, then the taxable perquisite is 7.5% of the salary. When we comes to leased by the employer and gave the perquisite to employee, then lease rentals or 15% of salary. Whichever is lower is taxable perquisite. So we have completed unfurnished situation, and when we goes to furnished situation, that is, it is again divided into two. That is unfurnished accommodation, you will arrive one amount, plus use of furniture, that is 10% per annum on original cost of the furniture, you will derive one amount. So when we add together unfurnished accommodation and use of furniture, we will arrive an amount that is taxable perquisite of furnished accommodation. In rent-free accommodation, we should understand the term salary. Here the term salary includes and there is also a excludes. What are those? First we are going to read about excludes, that is DA not provided, contribution by employer to welfare fund of employee, any allowance which is exempt from tax, and any perquisite. It is one of the most important, we should keep it in mind, that is any perquisite will not be included in salary, and advance salary if any, or arrear salary if any. These are the excludes from salary when we comes to the rent-free accommodation. And what includes? Let us see here. Here, what includes in salary from rent-free accommodation is rest of all elements of salary includes in salary. That is, whatever excludes when we taken from a salary, all are includes in salary. And when we come to point 2, that is, if accommodation is given in a remote area or mining sites, then nothing would be taxable. Let us see whole chart. So let us see once again education. In education, there is a two division, that is, one is allowance and another is perquisite. When it comes to the allowance, children education allowance is 100 per month per child is given, it is exempt, and excess of that is taxable. And the maximum restriction is 2 members is given the education allowance. And child hostel allowance, that is 300 per month per child is exempt. Here also there is a maximum restriction is 2 children. And when we come to the education perquisite, it is divided into 4, that is, if such facility is by way of employee training, nothing is taxable, and if the facility is given by way of reimbursement of school fee of employee children, that is taxable. And third, if the facility is given by way of payment of school fee of the employee children, it is also taxable. And when we come to the fourth situation, if the facility is given in employer owned or maintained educational institute, it is again divided into 3 parts, that is, if the facility is given to employee, that is, nothing is taxable. If the facility is given to employee child, up to 1000 per month per child is nothing is taxable, and excess of would be taxable. And if the facility is given to any other family members, anyone like brothers or sisters, any family relations, then the benefit is fully taxable. Now we are going through medical. In medical also there is 2, one is medical allowance and medical perquisite. If the employer provides any medical allowance to the employee, then it is fully taxable. When it comes to the medical perquisite, it is again divided into 2, that is, if the perquisite is provided to employee family members, that is given here, family definition is given up, that is spouse, children, and brother, sister, parents. Brother, sister, parents should be wholly depend on employee. And non-family members, it is taxable always. And when it comes to the family, it is divided into 5 subheadings, that is, if the facility is provided in employer owned hospital, it is exempt. If the facility is provided in government hospital, it is exempt. And if the facility if the facility is given by way of payment of medical insurance premium. And the fourth subheading is if the facility is provided in relation to specified diseases in approved hospital, that is exempt. And when we come to the fifth situation, that is if the facility is given in private clinic, that is up to 15,000, it is exempt, and excess of 15,000 it will become taxable. And if the facility is if the facility is given outside India, it is again divided into three headings, that is, and the last fifth one, if the facility is given outside India, then it is again divided into three types, that is treatment cost, nothing is taxable, and the stay cost, that is patient plus one more person, that is nothing is taxable, and the travel cost, the patient and the another person who carries the patient. If he is a small employee, that is gross total income is less than or equal to 2 lakhs, it is exempt. And if the big employees, that is greater than if the gross total income is greater than or equal to 2 lakhs, then it is taxable. So friends, let's have a look once again. Medical is divided into two, that is medical allowance and medical perquisite. If the employer provides medical allowance to employee, then it is taxable. And when it comes to the medical perquisite, it is divided into two, that is employee family members and non-family members of employee. If here family members means spouse, children, brother, sister, parents, and here brother, sister, parents should be wholly dependent on employee. And when it's come to the non-family members, if any perquisite provided to non-family members of the employee, then it is taxable. And when it comes to family members, if the facility is provided in employer owned hospital, it is exempt. And if the facility is, once again, let us look at purchase of second hand asset of employer. How to compute perquisite? Original cost of asset and deduct depreciation given it for completed years of services. After that, you will arrive a amount, that is value of second hand asset, and the payment made by employee, you should deduct from it that the total taxable perquisite value will be arrived. After that, let us have a look at rate of depreciation. The rate of depreciation is, for electronic items, depreciation rate is 50% under WDV. Motor car depreciation rate is 20% under WDV, and any other asset depreciation rate is 10% under SLM. So friends, there are some notes for purchase of second hand asset of employer. That is, depreciation is to be provided only for completed years. If an asset is purchased within 12 months of it put to use, then there would be no depreciation. And the rate of depreciation is here or given only for calculating perquisite only. In a case, if an employee purchases an asset which is given to him for personal use, then there would be a dual perquisite. That is, dual perquisite is up to point not owned, that is he is not owned the asset, then it is a use perquisite, and on the date of own, it is a purchase of second hand perquisite. Now we are going through lunch perquisite. Lunch perquisite and lunch allowance. If employer provides lunch allowance to employee, it is fully taxable. And when it comes to perquisite, if the facility is provided by way of tea, coffee, non-alcoholic beverages, then it is not taxable. And if facility is provided in remote areas, or mining sites, it is also not taxable. And if the facility is provided by way of meals, then up to 50 per meal per day it is not taxable, and excess of rupees 50 is taxable. Let us see some additional notes on lunch perquisite. That if the number of days for which the facility is provided is not given, one has to make assumption for the number of days. So in a problem, if they don't give the number of days, so you should make an assumption for the number of days. Suppose, and point 2, suppose if the value of perquisite provided is 70 per day and 10 rupees is recovered by the from the employee, then the taxable perquisite would be 20 minus 10, that is 10 per day would be a taxable. However, 50 is not taxable. Even if the facility is given by way of meal pass, then the exemption of 50 rupees per meal per day is available. So friends, if the employer provides a pass for meals, then also rupees 50 per day per meal is exemption is available. Now, facility by way of credit card. If the employer provides credit card facility to employee, then the taxable perquisite would be, that is, expenditure incurred by use of credit card by employee minus expenditure allocable to office use. So friends, expenditure incurred by use of credit card minus expenditure allocable to office minus recovery from the employee. This is the taxable perquisite in respect of credit card. Now when we come to the perquisite in respect of club, that is entertainment facility, let us look. If the facility is given for discharging official duties or official use, then it is not taxable. When it comes to second point, if the facility is given by way of group membership or corporate membership, then it is not taxable. And in third case, if the facility is given by way of gym, sports club, and uniformly to all the employees, it is not taxable. So when there is a differentiation between employees, that some class of employees is provided gym or sports club and some class of employees not provided, then there should be a taxable perquisite. If the facility of gym and sports club facility is provided uniformly to all the employees, then there would be not taxable. And in any other cases, and for any other cases, there is taxable. Tax treatment of leave travel concession, that is LTC. Now LTC exemption is given under section 10 subsection 5. LTC exemption is given only 2 times in a block of 4 calendar years, that is 4 calendar years. In a 4 calendar years, there is 2 times in a block. Exemption is given only in respect of travel cost incurred on family members. Here family definition is associate spouse and their children and their brother and sister and their parents. Brother and sisters and parents should be wholly dependent on Y. Exemption is given only if journey performed within India. So LTC exemption is given only when there is journey performed only within the India, that is not in another countries. And there is a concept of carry forward or carry over concession, which is as follows: that if an assessee has claimed no exemption in the last block or only one exemption in the last block, then he can claim 3 exemption, that is 1 plus 2 in the next block, subject to the condition that the very first exemption should alive in the very first year. And friends, there is also a restriction on number of children. Exemption for the child born on or after 1st October 1998 for LTC exemption. There are maximum number of children for exemption purpose should not exceed 2 members. Note, one of the note you should be recognize that if in the second delivery the assessee or the assessee spouse has a delivery with twins or triplicate or quadruplicate, then such set is taken as 1 for the purpose of count. So friends, after first birth, the assessee gets in second birth two children or 3 children. All the 2 or 3 taken as 1 for counting LTC exemption. This is all about LTC exemption. Perquisite in respect of car. In this, we had a table. Let us see. First column is owner and the second column is maintenance of expenditure and incurred. That is maintenance and expenditure incurred by whom, whether it is employee or employer. And the third one is use. One is official purpose, second is personal purpose, and third is partly official and partly personal. In this, there is again divided into 2 types, that is small car and big car. When we can say whether it is a small car or big car, if CC is less than or equal to 1600, then we call as a small car, and when the CC is greater than 1600, we call it as a big car. Let us see the tax treatment. If there is owner or the owner of the car is employee and the maintenance and expenditure charges is incurred by the employee, then there is no perquisite for official purpose, for personal purpose, for partly for personal or partly for personal. Sorry, for partly for official or partly for personal. And when the owner is employee and the employee took the maintenance and expenditure charges, then official purpose there is no perquisite. Where for personal there is a perquisite, that is expenditure incurred by the employer minus recovery. And when we comes to the partly for official and partly for personal, taxable perquisite is equal to expenditure of employer minus 1800 per month minus 900 minus recovery. The balance portion is taxable perquisite. And when we come to the big car, the taxable perquisite is expenditure of employer minus 2400 per month minus 900 minus recovery from employee. So the available amount is a taxable perquisite. When it comes to the situation of owner is employer and the maintenance and expenditure incurred by also a employer, then official purpose there is no taxable perquisite, and where for personal purpose there is a taxable perquisite to employee, that is 10% of original cost of car plus expenditure minus recovery is a taxable perquisite. When it comes to the small car, the taxable perquisite is 1800 per month plus 900, and when it comes to the big car, 2400 per month plus 900 per month is a taxable perquisite. Here 900 per month is for car driver. If they maintain separate car driver, it is charged for 900 per month. And if the owner is employer, and the last segment, that is owner is employer and the maintenance and expenditure are incurred by employee, then what is the tax treatment? If it is used for official purpose, then there is no perquisite. But if it used for personal purpose, there is a taxable perquisite, that is 10% of original cost of car minus recovery is a taxable perquisite. And when it comes to the partly for official and partly for personal, in the first segment, small car is 600 per month plus 900 per month is a taxable perquisite. And when it comes to the big car, 900 per month and 900 per month, that is 900 deals with the driver of car, so 900 per month plus 900 per month is a taxable perquisite of a big car. Note for the last, that is owner is the employer and the maintenance sign incurred by employee, that is note is for partly for official or for personal. Tax treatment of provident fund. Here the provident, what the meaning of provident? Provident means welfare. Now let us see the tax treatment of provident fund. In practical, we have 4 types of provident funds, that is statutory provident fund for government employees, recognized provident fund, that is also known as RPF, unrecognized provident fund, and public provident fund open to general public. Then what we need to learn is the tax treatment of following 4, that is employer contribution, employee contribution to provident fund, interest earned in the provident fund, and the treatment on withdrawals. Let us see a small diagram, you can understand some more clearly. Here this circle, it means this is a Mr. B provident fund account. Here there is an investment from employer contribution and Mr. B's contribution, that is employee contribution. And when there is a deposit, it is treated as an investment. For such investment, it is generated interest, and such interest is deposited in provident fund account only. After that, there is a withdrawal. Now let us see the tax treatment of employer contribution, employee contribution, and interest, and also for the tax treatment of withdrawal. Let us see tax treatment of contribution to the provident fund of employee, employer, interest, and withdrawal. If the employee contributes under to specific provident fund, ATC exemption is available. If the employee contributes to recognized provident fund, also ATC exemption is available. And if he contribute to URPF, that is unrecognized provident fund, then ATC exemption is not available. And if it is and if he contributes to PPF, that is public provident fund, ATC exemption is available. Now when it comes to the employer contribution to SPF, it is exempt. And when it comes to the RPF, he can avail exempt up to 12% of salary. Here salary means basic salary, DSO provided, and commission. And B, but that is excess of above amount will be taxable. That is, if it is 15% and 12% is exempt, balance 3% is taxable. And when it comes to the unrecognized provident fund, not taxable in the year of contribution, but would be taxable at the time of withdrawal. So when there is an investment or when there is a generate interest, there would not be taxable at the time of deposit or interest is accrued, but it is taxable when it is withdrawal. And in case of public provident fund, it is not applicable. And the tax treatment of interest. The tax treatment of interest is, if interest is generated in statutory provident fund, it is exempt. When interest is generated or for invested amount in a recognized provident fund, that is, interest is exempt from tax up to 9.5% rate, and the excess will be taxable. When it comes to the unrecognized provident fund, it is not taxable in the year which interest is accrued, but will be taxable at the time of withdrawal. As we said above, for the employer contribution, same as for interest also. And when it comes to the public provident fund, it is exempt. And the last treatment is withdrawal. Withdrawal, when you withdraw from a statutory provident fund, it is exempt. But when it comes to the recognized provident fund, it is exempt if he withdraw after 5 years. Please keep it in mind. That is, if he withdraw only after 5 years, it is exempt. Otherwise, it is taxable. And when there is a withdrawal from unrecognized provident fund, here there is a situation that if withdrawal by employee, that is employee's contribution, principal portion is exemption, that is invested amount is exempt. When it comes to the interest, it is taxable under income from other source. And when it comes to the employer's contribution, the principal portion is taxable and the interest portion is also taxable under the heads of salary. And when it comes to the public provident fund, it is exempt. So have a look for complete table. Our next topic is section 16, deduction. Deduction under section 16 from gross salary. It has divided into 3 parts, that is section 16 subsection 1, standard deduction from gross salary. This deduction is no more available in salaries. And next is section 16 subsection 2, that is deduction of entertainment allowance from salary. This deduction is allowed only government employees, that is central government and state government. For these employees, least of the following is exempt and the remaining amount is taxable. Let us see what is the exempt portion. That is 20% of basic salary or actual amount received or maximum amount 5,000, whichever is low is exempt, and remaining is taxable. That is, after getting amount, that is exemption amount, the balance portion is taxable. When we comes to section 16 subsection 3, deduction of professional tax. Professional tax is a levy by state government on the employees. Now, deduction of professional tax is allowed from gross salary only on the paid basis. If professional tax is payable by the employee, is paid by the employer, it is a perquisite in the hands of employee. First, it should offer as a taxable perquisite, and if the allowed as deduction from gross salary under section 16 subsection 3. Tax treatment of ESOP. ESOP refers to Employee Stock Option Plan. It is also called as Employee Stock Option Scheme. Under ESOP, the shares are allotted to employee at very nominal value by the employer company. It means if you are working in a company, the share value of that company is 100 rupees. So employer company is giving, that is offering you to buy their shares at 95. The remaining 5 rupees is a taxable perquisite in the hands of employee. Therefore, the taxable perquisite should be determined as follows. That is, taxable perquisite is number of shares exercised into fair market value of date of exercise option into allotment price per share. The the derived amount is taxable perquisite in the hands of employee. So friends, we have successfully completed our salaries topic. Let us see another topic in next class. Thank you.